Good morning, dear learners. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the next lecture of my course on financial literacy. This is Module 2, Key Components of Personal Finance, and lecture number 10, Inflation. In the previous lectures of this module, we had discussed the various concepts such as income, expenditure, savings, borrowings, as well as we had also discussed the various sources of income such as active and passive sources of income, as well as we also learned about the concepts of gratification, on the basis of which an individual should plan their financial activities. Now, in this lecture, we will be going to understand the concept of inflation that also contributes to a great extent at the time of deciding which of the investment proposals are profitable and we should invest in them. So, in this lecture, we are going to cover the introduction and meaning of inflation, the various causes and effect of inflation on the economic activity and the revenues that we earn from the investment, as well as the consequences of inflation in any economy. So, if we talk about inflation in simple terms, it is a gradual loss of purchasing power of money that is reflected in a broad rise in the prices of goods and services over a time in the economy. The inflation rate is basically calculated as the average price of increase of a particular basket of goods and commodities of selected country within an year. So, basically inflation is defined as a sustained increase in the prices of the goods and commodities in a country and fall in the purchasing power of the currency. Whenever the level of currency of a country exceeds the level of production, then this kind of economic criteria may persist. The value of money depreciates with the occurrence of inflation in an economy. That simply means if the inflation rises in an economy, then the purchasing power capacity of the currency of the country depreciate, and hence you will be able to purchase less commodities, less services in the same unit of the currency due to the effect of inflation. The various famous economists such as C. Crowther have defined the term inflation as it is a state in which the value of money is falling and the prices are rising. That means the value, that is the purchasing power of the money, will fall, but the prices of the products and commodities will increase. In economics, the word inflation refers to the general rise in the prices measured against the standard level of purchasing power. So, basically inflation is a condition where we see a general price level increase in the products and commodities of the country, as well as we also observe the depreciation in the total purchasing power of the currency that we use for the purpose of exchange process. In the current year, the Reserve Bank of India has set an inflation target of 4% with a tolerance band of plus minus 2%, aiming to keep the inflation between 2 to 6%, and recent data indicates that India's consumer price index, that is CPI, inflation has remained within the target range as on May 2024. So, inflation further declined to a 12-month low of 4.75% in the current economic year. If we talk about the various other concepts that we may associate with the term inflation, then they are deflation and recession. Deflation is just the opposite condition of the inflation, whereby it is the persistent decrease in the price level of the products and categories, and it may occur when the inflation rate in the economy falls below the 0% level. If any economy faces the period of deflation, then after that they may also face the recession. A recession is basically a period of slow economic activity. Recession is usually preceded by a major drop in the consumer expenditure, that is the CPI, and economic metrics such as GDP, profits, employment collapse, all these may be observed under the condition of recession. So basically deflation is a condition whereby the purchasing power of the money increases and demand of the consumer rises in the economy, whereas the production level in the economy may decrease, and hence the economy may not be fulfilling the total demand of their consumers, and therefore the economic slowdown may be felt and low economic activities will be done. That will be a condition of recession. Now let us discuss some of the other terms related with the inflation. What are the various types and categories of inflation? So these are basically categorized under the creeping inflation, then walking inflation, as well as some other forms are there such as running inflation, galloping inflation and hyperinflation. That are the various categories. So let us first discuss about the creeping inflation. This is a kind of slow and steady rise in the prices of the goods and commodity, and such kind of inflation is basically considered as a beneficial inflation for the economy, as in such cases only 2 to 3 or 4% of rise in the prices of the products and commodities are observed. So creeping inflation basically helps the individuals to invest into more and more economic activities so as to fulfill the demands of the consumer in the market, and it do not intervene aggressively in this scenario. So the central bank basically take a back seat in such cases and do not take an active action for avoiding such kind of inflationary condition in the economy. The next one is the walking inflation. Walking inflation is a moderate level of inflation, but it is still manageable by the economic forces. So at this rate, the central bank, that is the RBI, it starts closely monitoring the various escalating fluctuations of the inflation rate, but it do not actively intervene into the economy. So if annual inflation in any country rises from 4 to 8% and consumer feel the effect of the prices increase more noticeably, then such kind of inflationary condition are known as the walking inflation. So government may adjust interest rates on the borrowings, loans and advances for the purpose of adjusting the conditions of walking inflation in the economy. Now next one is the running inflation. Running inflation is a situation where a significant percentage of increase can be observed into the inflation rate in the economy, and this kind of situation may start damaging the economic stability of the nation. So this level of the inflation may reduce the consumer purchasing power, as well as it will also influence the business confidence negatively. Central bank may take some strong measures, such as they may increase the interest rates as well as other steps for the purpose of slowing down the inflation. So if in any economy this inflation jumps from 10 to 15%, the cost of living rises rapidly, and thus it needs to be controlled by the government. Now the next one is the galloping inflation. When the rise into the inflation rate is more than 20 to 1000%, then it is an extremely high rate, and this is known as the galloping inflation, making money losing its value rapidly in the market. The economy faces some serious instability in such conditions, and business and its individuals may struggle to keep up their economic activities and standard of living in such situations. So government often fail to control such kind of inflationary condition in the economy, and if the inflation in any country reaches 50% annually, the goods that cost $100 today may cost $150 within a year. So that may be an uncontrollable situation for the government. Now the next one is the hyperinflation. When the inflation rate rises more than the 1000% of the existing inflation rate, then this kind of inflation may exist. This is the most extreme form of inflation, where prices of the goods and services rise uncontrollably and the currency becomes nearly worthless for the individuals and the entrepreneurs, and in such cases the economy may collapse also. So the government may print some excessive money for meeting such kind of crisis, but again it will be going to worsen the conditions of economic growth in the economy. So these are the various types of inflation that we have discussed. Now let us come to the next part of the various measures of inflation, how we can measure what is the inflation rate in the economy, and the measures can also help you to understand what are the various causes and how it can be controlled. So the inflation is basically measured by using indices that track price changes in the goods and services over a period of time in the economy. A price index is basically a statistical measure that reflects the change in the average price level relative to the base year of the products and commodities in the country. So basically in India, the two most of the used major indices is the wholesale price index and consumer price index. So let us discuss these in the detail. The wholesale price index is also known as the producer price index. It is a family of the indices that measure the average change over a period of time in selling prices by domestic producers of goods and services in the economy. PPI basically measures the price change from the perspective of the seller, that means the producers of the country. If the WPI inflation rate rose to, if we talk about the current scenario, the WPI inflation rate in our economy rose to 2.38% year on year, slightly up from the 2.31% in the January 2025. This increase was primarily driven by the higher prices in the manufacturing sector, that is the capital good industries and the FMCG sector of the country, whereas particularly it is observed by the consumers in the food products, as well as rise in the prices of fuel and the power supply in the country. The next index is the consumer price index. It is a measure of price changes in the consumer goods and services in the country, that is the products that we consume as a user in the economy. So CPI basically measure the changes from the perspective of the purchaser. So as a consumer, whatever changes in the prices of products and services we are observing, that is the method of the consumer price index. As of, if we talk about our country, as of February 2025, India's consumer price index rate declined to 3.6%, down from the 4.3% in the January 2025. This marks the first time in 6 months that the retail inflation has fallen down below 4% in our country, primarily due to the significant decrease in the food and beverages prices in our country. So now let us talk about the various differences between the two indices with the help of which we measure the inflation in the economy. So on the basis of purpose, if we talk about the consumer price index, measure the average change over a period of time in the prices paid by the consumers for a basket of products and commodities and services in the economy, whereas the wholesale price index measures the average change from the perspective of the producer, that is the goods and commodities at a wholesale level, that is before reaching to the ultimate consumers in the economy. Whereas if we talk about the composition, the CPI includes categories such as food and beverages, housing, apparel, transportation, medical care, education and other facilities, whereas the wholesale price index primarily covers the articles like agricultural product, fuel and power, and other manufactured product, that is the capital goods or capital asset of our country. If we talk about the weightage, CPI assigns the significant weight to the food items given their substantial share in the household expenditure, whereas the wholesale price index places more emphasis on the manufactured goods, that is the capital asset, reflecting their prominence in the wholesale trade. If we talk about the publications, so we can get the informations related with the CPI with the help of the National Statistical Office NSO under the Ministry of Statistics and Program Implementation, whereas the wholesale price index are released by the Office of the Economic Advisor, Ministry of Commerce and Industry. Now, let us discuss about the GDP inflator. GDP, that is the gross domestic product of any economy. The GDP deflator basically measures the price level changes across the entire economy, covering both goods and services that are produced domestically. So, it reflects the overall inflation rate by comparing the ratio of nominal GDP to the real GDP of the country. The GDP deflator is an economic metric that measures the overall level of price changes in the economy, and it reflects the inflation by comparing the current price level of all the goods and services produced in the country with a base year. So, for the formula for calculating the GDP deflator, we have nominal GDP of the country divided by the real GDP multiplied by the 100. So, these are the various measures with the help of which we can calculate the inflation in our economy, that is the PPI, CPI and GDP deflator. Now, let us understand what are the various features of these measures of the inflation. So, the various features may be discussed as comprehensive inflation measure. Unlike the consumer price index, the wholesale price index, which track the selected goods and services, the GDP deflator basically covers all domestic produced goods and services. So, these are concentrating only on one particular type and category of products and services, whereas the GDP deflator covers all domestic produced goods and services in the country. Then there is no fixed basket of goods. Unlike CPI or unlike PPI, the GDP deflator accounts for changes in consumption and production patterns over time. So, there is no fixed basket of products and services in case of the GDP deflator, as well as the base year comparison is possible. It helps to compare the price level of the current year with the chosen base year to determine the inflation trend in the economy. Here you can see an example of the calculation of the GDP deflator also. Now, let us move on to the next part of the lecture, that is the types of inflation. If we talk about the types of inflation, basically there is demand pull inflation, cost pull inflation, as well as we will be also going to discuss the various impact of inflation in the economy. So, if we talk about the demand pull inflation, it occurs when demand of the products and services exceeds its supply in any economy, then such kind of inflation may be observed. The excess demand results in the price being pulled up by the producers, and more money in circulation leads in the increasing purchasing power in the hands of the consumer, driving the prices more further up in the economy. So, examples may be there that the government stimulus check in the increasing consumer prices spending in case of the demand pull inflation. Then there is cost push inflation. In the case of cost push inflation, this scenario may happen when the cost of production rises, forcing businesses to increase the prices of the goods and commodities in the economy. The various factors contributing to the cost push inflation may be higher wages, raw material cost and supply chain disruptions in the economy. So, a surge in the oil prices may lead to the higher transportation cost, and it can increase the prices of products and services in the economy. This is an example of the cost push inflation. Now let us understand what may be the various effects of inflation on the economy. So it may increase the interest rate. To control the inflation, the central banking agencies of a nation may raise the interest rate. So it may affect the various aspects of the economy, from reducing the purchasing power of the money in the country, as well as increasing the interest rate to widen the income of the lenders and borrowers by affecting the investment return in the economy. So this may be a major impact of the inflation in the economy. The second impact can be observed as the reduced purchasing power in the hand of the consumer, whether it is a wholesale consumer or any other retail consumer. So inflation basically erodes the purchasing power of the money. In the previous lecture, we had also discussed that time value of money concept is possible due to the inflation and other economic factors. So inflation contributes in deteriorating the purchasing power value of the currency in the economy, meaning that a consumer can buy fewer goods and services with the same income, ultimately affecting the quality of life and the standard of living of that consumer in the market. Then the next one is the business cost and planning. If we talk about the impact on business cost and planning, the inflation raises the operational cost for the businesses, specifically in the material and labor costs, leading to the challenges in pricing of the final products and services, and long-term planning of the business may also be affected by that, and the business may struggle to maintain the sufficient profit margin. Now, let us discuss the relevance of the study of inflation in the context of personal finance. Why we are understanding this concept and how it will be going to help us to manage our personal finances. So, it is a crucial concept as it affects our purchasing power, savings, investment, returns, and overall financial planning. So it helps the individuals as well as entrepreneurs to make informed financial decision about managing their finances well, saving enough for the future, and investing wisely in the various types of investment avenues that are available to them. So impact on inflation of the personal finance can be very easily observed as it erodes the purchasing power. So over a period of time, the same amount of money will buy a fewer goods for you, a fewer services will be available in the same unit of the currency, and therefore you need to think of the various ways with the help of which some capital creation may be possible on the money that you are keeping for your future. Then it also affects the saving. Money kept in low interest saving account may lose value due to the inflationary trend, and it may not be helpful for you in the future to buy enough of the products and services to maintain your living standard. Thus, an individual must consider the inflationary trend in the economy for the purpose of deciding their investment. So it influences the investment decisions also. So investment like stocks, shares, gold, and real estate can help to beat the inflation, as these types of investment basically appreciates, and whereas the other types of investment where we get regular return but lower, that is the fixed deposit, may offer a lower return to us, and thus it may not help the individual or the entrepreneurs to manage the negative effects of the inflation in the value of money of their purchasing power. Next is the impact on the debt and loan. If we are taking loan for managing our business or personal finances, fixed rate loan may become cheaper in real terms. During high inflationary trend, the variable interest rate can increase our borrowing cost, and hence it can create financial stress and burden, and that is why the floating interest rate borrowings must be avoided by the individuals and the entrepreneurs for the purpose of saving their future. Now, in the context of budgeting, if we talk about the significance of inflation, it helps us in the long-term planning as well as to adjust our expenses also. Whenever we are creating a financial plan, inflation should be considered for the purpose of estimating the future expenses, that is the education, purchase of home, vehicle or retirement planning, as the future prices of these particular services and products are going to increase. Whenever we are going to do long term planning, we must consider the trend of rising prices of all these products and services so as to save enough for purchasing all these types of products and services. Then we need to adjust our expenses. Monthly budgets must be prepared, and it should accommodate the price increases in the essential items for maintaining our standard of life, that is the food, fuel, rent, etc., so as to have sufficient money in our hand to manage our financial well-being. Now let us discuss how we can manage the inflationary trends. So avenues to hedge against the inflation are stocks and equities, real estate, commodities and inflation protected securities. So with the help of investing into these stocks and equities, we can very easily invest our money into the long term investment where the risks are higher, but the prospective chances of earning higher returns are also higher. So investing in a diversified portfolio of equities can help us to grow our wealth and maintain the purchasing power of our money. We can also invest into the properties investments, that is the things that the value of which appreciate over a period of time, such as land, building and infrastructure. We can give it on rental basis and we can earn some rental income on these investments, as well as this will help us to hedge against the rising inflation also. We can also invest into some valuable metal and commodities such as gold. Gold has traditionally been viewed as a safe haven asset during the periods of high inflation and economic uncertainties. So the value of gold often rises in the international market also, and hence it helps to maintain the purchasing power of the consumers when the currency declines in any economy. Then there are some inflation protected securities such as treasury inflation protected securities. These are government bonds specifically designed to increase the value with the inflationary trend. So this ensures that your investment keep pace with the rising prices, and it helps you to protect yourself from the risk associated with the inflationary trend, and your purchasing power in the future will remain intact if you invest in such kind of investment opportunities. So these are the various types of avenues where you can invest, and you can very wisely avoid the risk of inflation on the purchasing power of your money that you are saving for your future. So with this we come to an end to our lecture number 10, that is inflation. Now I hope with the help of discussion of different topics under the module 2, you must have understood the importance and significance of all these concepts and their knowledge in the management of personal finances. Thank you.